All right, everyone. Thank you for joining our monthly live. We should have some more hopping on here as we keep going, but we're going to go ahead and kick off. We were going to go live in the group, but as y'all just heard, apparently there's more buttons I got to click there. So let's go ahead and kick it off. We've got a lot of great, things that we want to cover today, and we do have two fine guests here that are going to be sharing some information regarding the commercial brokering, commercial lending process, and kind of the services that they provide. And that's going to be our very own Miss Radhika and Mr. Peyton over here. So y'all can wave if you want. Yeah, there you go. All right, cool. So we're going to be going through a few examples, the process, answer a lot of questions. At any time that y'all think of a question, you don't have to wait to the end. You can either put it in the group chat or raise your hand, and as we see you, we'll call on it. And we'll get you those. So that way, if we're still on that slide or still on that subject, it's still relevant to that. I like doing it that way. So that way we can make sure as we're flowing through, we got your questions as we're talking about that subject. So feel free anytime, raise your hand, put a chat in there, and we'll get those. This is for you to learn. There are no dumb questions. Trust me, this is coming from a Marine of 9 years. Okay. I promise you, I'm still alive. Now that my drill instructors used to tell me there's plenty of bad questions. All right. Which I pay with push-ups. No push-ups are going to be issued for bad questions. So we love questions. Please keep us on our toes, challenge us with your questions. I'm looking forward to it. So, but real quick, we've got some exciting announcements for MPIG, Military and Patriots Investment Group, right? We have now in this last month got 2 deals under contract, and I just got off the phone, and we might be on not 1, not 2, but 3 more. 3 more groups or 3 more deals, all self-storage. We're really picking up the momentum there, and we're really loving that. And I would say our lending process and having the loans that we're getting on our deals is a huge piece of that. But we are going to need our group. We are going to need you. We are going to need your help to get more active in our deals, whether that's raising capital, or if you really don't know where to start and want to kind of just get your feet into the deal, we've officially decided, it's official. We are going to launch what we call the co-sponsor program. So the co-sponsor program is going to be where we are going to give you some basic training on how to find the deals, how to screen the deals, what all the information you need to even be able to do the screening. And then we're going to allow you to submit that directly into our portal. So our team of analysts will screen your projects, and we will bring you in as a partner. You will be partnering with us, leveraging all of our experiences, leveraging all the experience of our network to help you be a part of those deals, knowing that they're going to close and you're going to have the best sponsorship team possible looking over your deals. Now, this is only going to be for self-storage for the time being. As we, take this on, get it going well, we could see that branching off across other industries. For the time being, it is going to be self-storage. I am going to put out a link to sign up for that, so that way y'all can sign up for those. There will be probably twice a month classes that we are going to be doing. So we are going to be having those classes twice a month. If I said week, I'm sorry, twice a month. So I'm going to put a register out there so that you can register for this. We're only going to be taking a small group at a time to really walk them through, how do you find off-market deals? Where can you find some pre-market deals? And then if you're really just trying to practice your underwriting skills and all of that, you can, look at some of those on-market deals just to practice that flow. But not to take anything else away from the main topic at hand, I just wanted to make that quick announcement. Keep an eye out in the group. We are going to be posting that. You must register for it, and you must be on those training calls so that you know the criteria, everything. ABC. I mean, we're making it Barney style on that. So good stuff. And we are ready to rock and roll. So if you got any questions on that, you can put them on that when we do the register and ask that. But we're going to be rocking and rolling on that to help more and more people get their deals and learn while they earn. So you will be on the deal, getting equity, getting paid as you're learning. Other courses make you pay up front. Then you got to go find your deals. Then you still got to build the team to take it down. We're going to be different. We're here to partner with you, and we all grow together. We all rise together, and hopefully we can all retire and go to the beach together, right? Make sure you wear sunscreen, okay? Because I got to put a lot up here. But anyway, let's kick it off. Let's have some fun. Peyton, let me make sure. I don't think I made you a co-host, so no, you are. Okay, good. So Peyton, Radha, I appreciate y'all being on here. I'm gonna go ahead and fade to the back and let y'all take it and run with it. And keep in mind, I'm gonna keep an eye on the chat. So if anyone wants to comment in the chat, feel free. I'll do that. Or if you want to hit the little raise your hand button somewhere, and we can I'll call on y'all. So y'all go ahead. Peyton, Radha, the floor is yours.
Sweet. Thanks, Wesley. Appreciate it. I'm just going to give you guys a little background on kind of my history, my story, and how I got started in this industry. I started about 2 years ago, and really how it happened is Wesley kind of helped me out on the acquisition side, kind of really helped me get to that point where I could start underwriting projects myself, and really starting to feel more confident about my abilities to take down deals on the acquisition side. And then I really started getting interested into the financing side, and how can I not only help my own projects, but also help other individuals in this industry as well secure one of the most important things on a project, right? Your financing is going to take out potentially 75-80% of your total capital stack, right? So I really started falling in love with the financing aspect, and I've really just been working very hard at it over the last couple of years just to make sure I build those relationships with direct lenders who they're the ones that are educating us the most on the outlook of the financial market and different products that they're rolling out, stuff like that. And I've really started to grow to love building these relationships with lenders and also helping clients out. So that's kind of my spiel as to why I got started. And Radha, I don't know if you want to give a brief little background over why you decided to start.
Absolutely. Thank you, Wes. Thank you, Peyton. Hello, everybody. This is Radhika Ganatra. I'm a licensed loan officer here in Texas and eventually became a commercial mortgage loan broker as well. The journey started like this. I'm an MBA in finance and HR, plus coming from a real estate plus mortgage background family. So always kind of had been in this particular field, always wanted to do something what my father did all these years. However, I started my journey coming out of college as an HR individual. I was an HR generalist working for a healthcare company for 7 years. And then COVID hit 2020 and things changed for everybody, for most of the people, including me. And I decided to be in the mortgage industry at that point, just took a leverage opportunity and just made a switch. Decided to get a license first, took the license and started working as a single family residence loan officer. As I was working into loan officer field, I found out that I really kind of love numbers. I really like that where people are investing their money into. And when I was going through everybody's portfolio, I noticed that most of the people, once they are settled into their lives, they start putting money elsewhere, which is most of the time I've noticed is real estate. And that's when I realized that as I'm helping individuals getting their own primary residence, why should I not get on the other side when people start thinking about diversifying their portfolio? And that's when I decided to be in the commercial field as well. And while working on one of the hospitality Montana deal, I came across Wesley, and that's how I joined this team. And ever since has been grateful and so happy to be part of this team. And I just cannot be thankful enough. And thank you so much for having me today. Now we'll just get started on our presentation. I'm going to share something with you all, the presentation that me and Peyton has designed for you all. Are you able to see my screen?
Yes, I can.
Yeah.
All right. So we go by Centroid Lending. We are mortgage brokers. We help investors and individuals get the best lending possible. No matter what kind of deal that you have, we are capable enough to screen your deals. We are capable to do underwriting for you all and kind of hold your hand into anything that you might be needing our help into. When we talk about asset class, we are able to help you all into multifamily asset class, self-storage, RV and boat storages, RV parks. If I've missed upon any of the asset class over here, that doesn't mean that we don't cover. We are basically well versed into understanding the underwriting, the background of these particular any particular asset class, hospitality, retail buildings or strip malls. What we can do is we can basically, when you come to us with your deal, we can screen your deal ourselves from the point of view of the lender and see what lender would want to see in this, how well prepared you are with your business plans, what kind of returns you are expecting to get from this. Sometimes it's a yield based, sometimes it's a cash flow based, sometimes it's just the equity, sometimes it's just getting away from the tax returns, paying more taxes and all, just prorating your investments. All of that. So we are able to help you in any asset class whatsoever, not limited to any one. We have done deals in each and every asset class so far. I have helped most of the investors into multifamily, but we are diving very much into self-storages now as well, since multifamily little bit getting conservative from the lender's point of view, just because they are protecting interest of the renters at this point. And COVID hit and interest rate went up and all. But as I said, we are well versed into each and every asset class. Moving on to the next one, lenders. There are a bunch of other lenders out there that can help us. If one lender can deny the loan for one thing, we can definitely walk into another bank shop or another lender shop and get that done. Now I'm going to dive a little bit into these, each and every lender types. Because every lender has their own specialty. They like something, they don't like something, they operate in a certain manner. And when you come to us with your deal, we are able to explain you what lender to go to and why. Because we have worked with each and every lenders. We are in band with multiple lenders across the country. We have worked with all of these lenders in any city or state that you can think of. I personally have held in Arkansas last year, Arizona, Illinois, Montana, Virginia. Obviously, I'm in Houston, Texas, so Texas is my bread and butter. But we have across the country been with all kinds of lenders. Now, when to go to small banks or credit unions? So most of the time what happens is people come to me and they say, hey, I want an SBA loan. Okay, I understand you have a little bit of background about SBA loan, but you probably do not know what are the restrictions, what are the constraints are to fit into that vanilla tiny box that you may not know, you may not be aware about it. So we will be able to tell you why not go with SBA, why not go with banks, why not go with large banks. So we will evaluate your project first. And talking about small banks or credit unions, these are the lenders they like to go with the area. Because they are into that particular area, they are more keen into the remaining in the same area because they know the crime rate in the area. They know the growth happening in the area, new things coming into area, what kind of median household income is there in that area. So they are more into areas. Secondly, the loan amount from 5 million to 7 million up to 10 million, small banks and credit unions are okay with. Credit unions are actually sometimes even smaller than that, but small banks go up to 10 million. Credit unions, on the other hand, has a lower loan limit as well. So let's say sometimes people are only wanting to have $80,000 or $100,000 loan just to acquire the land. Then construction is separate. So when you're just wanting to get the land acquisition, then for only $100,000 or $200,000 loan, credit union could be the best option. But other banks may not take those cases in hand because closing costs are too high. The manpower goes behind it, the work goes behind it. They are not most of the time happy doing those things. So small banks and credit unions are for smaller loan amounts, more into the area. They are recourse loans. They like to go after your personal assets. personal guarantee. They want you to have recourse, 100% collateralized loan amount recourse in there. Next goes regional and large banks. Obviously, when we see large banks, what we think is they lend large amount of money, which is true. They do give more money, but their due diligence is too much. Secondly, their interest rate could be a little bit higher. They mostly go with the prime rates, as in WSJP or Wall Street Journal Prime. Plus, they have their own margins on top of it. They sometimes price it on SOFR, they price it on Treasury. So we kind of evaluate that which banks are picking or pricing it on the lower indexes. So that it has to be like 10-year treasury or 5-year treasury. Then on top of it, if they are charging 2% or 3% margin, then that's definitely not that expensive. But I have seen large banks or national banks pricing on WSJP, plus on top of it, they are charging 2% margin or 2.5% margin. In this interest rate market, those interest rates come out to be close to 8.5%, 9%. Then they are no less than going to a hard money or a private lenders. So sometimes large banks could be a constraint or a problem. Yeah, they can lend on a larger loan amount. When we have that, those are definitely the best options. But these are the things to keep in mind when we go with them. Next comes agency, everybody's favorite. Fannie, Freddie, HUD, FHA, more than 4 units. You are definitely, you should definitely think about going to agency loans or Fannie Mae or Freddie Mac loans. Only thing is your asset has to be cash flowing asset. What that means is that occupancy of your asset has to be more than 85% or 90%. Only then they would take the case into consideration. Your asset has to have 1.25 DSCR. So they like cash flowing assets. They don't like short-term loans. They encourage staying in the loan for a long time because they want to have or they want to earn from your loan for a longer period of time. So those are the things that they do not like refinances. However, these loans are non-recourse. So those who don't want to do personal guarantee, they don't want to risk their own assets, then agency loans, if you fit into that, that would be the very first choice, even from our end. Our advisors, our mortgage brokers will definitely take you to Fannie Mae or Freddie Mac loans if your asset or as a broker or as a borrower, you qualify for that. Next comes CMBS. Those are mortgage-backed securities. These are more for stable assets. So again, it's more like Fannie and Freddie, but they are also discouraging refinance and the prepayment penalties are too high when it comes to CMBS. So if you want to just refinance and want to gain some short-term benefits from the project and want to just exit it, then CMBS may not be the right option. But otherwise, mortgage-backed securities interest rates are also low. They are also a very good product. We have multiple lenders that we work with. We are in bandwidth and we can definitely get you CMBS loan if your product and as a borrower you qualify for it. Then comes private lenders, more like hard money lenders. Hard money lenders, we would only suggest you to go with those because as we all know, hard money lenders are highly risky, high interest rates. And high interest rates, why? Because they're able to close faster. They can give you more leverage on your loans. But at the same time, hard money lenders are very hard to trust. I would highly recommend that you go with the mortgage broker's advice and their experience because there are so many scammers out there. They sometimes charge you upfront money for even starting your loan, for doing third-party reports. So definitely consult with the mortgage brokers like us, me, Peyton, or anyone in our group to find out whether these private lenders are good or not. And we work with many good lenders. We have evaluated them. We have seen their ratings. We have seen their historical data. And we only trust those and only we can take you to those hard money lenders. But otherwise, hard money is definitely the last option that we would suggest you that you go with. Unless you have less bad credit, your tax returns are not so good. As I said, your property is in a bad area, only then those people will get into those loans. Then comes preferred equity and mezzanine. Those are second lien position lenders. When you have first lien position lender already in place and you still want to share some equity in exchange of some capital investment, that's when preferred equity or mezzanine comes into picture. And we work with many lenders who provide those as well. So just to sum up on what I said about all the lenders, we basically work with each and every lenders that you have need in. We will definitely take you to the right lender. We will suggest you and advise you on whom to go with, but we are not restricted to any one or the other.
Yeah, I think one of the biggest takeaways from the previous slide, the types of lenders, is going to be each and every type of lender has its strengths and it also has its weaknesses, right? So it really just takes the experienced eye and understanding, looking at an overall project, looking at the overall pro forma of a project to really understand what is going to be the best product for my business plan, right? So, we're constantly trying to stay in contact, stay up to date with each and every one. CMBS, I'd say the end of last year, CMBS leverage points were extremely low. Right now, CMBS they're having some issues currently with the current market. And so their leverage points were, 50% loan to value were good leverage points for some CMBS products, right? So it takes the experienced eye to really understand what's happening in the market. We see this earlier Q1 this year, agency was really making a push to keep products moving and keep investors investing in real estate. They had a lot of discounts. Freddie Mac small balance loan dropped their rates. A lot of these lenders, they're trying to make adjustments here and there to make sure that investors are still able to stay competitive and stay, investing in projects. So next slide, please.
That's absolutely right. Does anyone have any questions? No?
Sweet. So yeah, taking away the types of loans. It really starts with what the business plan is and what your project is looking like. For your value add projects, you're kind of limited to a certain type of loan. Bridge product is a good one. You can also resort to small local banks or even large institutional sized banks. But really with the bridge products, you're looking at a higher pricing and higher leverage point, right? So we've seen earlier, I'd say 2020, 2021, we were seeing 80-85% loan to cost. Now it's gone down significantly. 75% is kind of where we're maxing out at for loan to cost on bridge. But also we're seeing the pricing and the interest rates are extremely high too. Like Radha said in the previous slide, a lot of institutions are on prime. And then, not only are they on prime, but they also have their own margins. And so, that really really hinders the investor's ability to stay competitive with their offers and stuff like that. Luckily, like she said earlier, we're always looking to source lenders who are on either SOFR or the 10-year, 5-year treasury rate. So, those options right now are looking like they're kind of the best options that we're looking for. But ultimately, your bridge product is, you're going to use a bridge product to cover the renovations, the cost, closing costs. And so we really like using bridge products, but like I said, with interest rates, it's really tough to secure good financing for value add projects right now. And so a lot of investors are kind of having to resort to more permanent financing on a project that's still a value add play, right? And so with the permanent products, it's very, very tough. They're very strict on what they're looking for. It's got to be cash flowing. There has to be certain DSCR requirements, potentially certain debt yield requirements starting day one. And so with permanent products, you're really looking for it's going to be lower leverage, but you're also going to see a lot better interest rates, a lot better pricing. But like I said, they're really looking for a lot of constraints with permanent products. The interest or the debt yield, the DSCR. They're really stressing the DSCR right now. And with the permanent products, they're not going to cover any type of renovation cost or CapEx costs, only really going to be covering the purchase price, right? And so as you can see on the slide here, we're looking at SBA 504 loans or SBA 7 alpha loans. Those are very popular and can't use them multifamily, but very popular in the self-storage space. Those are considered long-term. long-term products, but their leverage points, potentially they can get you to 90% loan to cost. And so those are very popular in the self-storage space and other industries that, allow the SBA to lend on that. And lenders love the SBA product because it's backed by the government. The government's guaranteeing a certain percentage of that product. And clients love the SBA product as well because of the high leverage. Something else, we also look at construction loans. We're really diving into sourcing a lot of construction lenders at the moment. Construction loans surprisingly are a lot more competitive than you think. We've seen as high as 80%, up to 80% loan to cost. It's most of the time construction product. Even if you're sourcing it from a non-recourse lender, there's going to be a recourse component to it during vertical development. But with something that we've been able to do, even with local banks and large institutional banks, we can set something up to where it's, recourse in the beginning of the project, but once a certain DSCR metric is hit or a certain debt yield is hit on the project itself, it can trigger what we call a burn off. And so let's say the DSCR on the project hit a 1 or 1.1, it triggers the burn off. Instead of 100% guaranteed, it's now down to 50% guaranteed, right? And even moving forward in the project, you hit a DSCR of 1.2, 1.3, and it just completely triggers another burn off. And so now we're looking at a complete non-recourse product once that DSCR has been hit. And so that's kind of how we've been structuring a lot of those products. Very beneficial, very, very useful. You'd be surprised of how many local banks, credit unions, large banks are willing to do that, right? It just takes the understanding of being able to ask, do you guys offer, some type of burn off strategy that we could potentially use? So, Radha, do you have anything else for this slide?
I would just say that for SBA loans, they are more famous for the business acquisitions.
Mm-hmm.
However, it's again a very, very tiny box to fit in when it comes to the approval for SBA loans. Sometimes in SBA 7.5 loans, you get 100% financing, and that's the rumor goes out there. And many times clients come to me, hey, I have heard many brokers or many lenders are giving 100% financing. It could be true if you basically check off 100 conditions that they have. Each and every box must get checked off in order to get qualified. So right now I'm helping 2 clients get SBA loans, one in Virginia and one is in Vegas, furniture store acquisition and a restaurant acquisition. We are having really hard time jumping off the hoops on getting the approval for those because there was a seller's financing in place. They emphasize a lot on having experience of the business. They emphasize a lot on having a good cash flow in the business. So these are the things that you may not be aware about. And the sellers who are selling the properties, they don't want to show good income coming from those particular businesses for an obvious reason that they don't want to pay taxes on it. However, one fine day they decide to sell the business, and that's hurting the borrower because their historical financials are not supporting the loan amount they want to get. And that's what hurts the most. And that's when sellers must start preparing 2 years in advance if they want to sell one particular asset. Only then you can get the most out of it in terms of leverage price. So that's all I would add. But otherwise, yes, as Peyton covered, these are all we can still help you with. Even USDA loan, which is not mentioned over here, which is in rural areas. Government grants are there. We just have to see whether this particular property, as per the government's eyes, considered in a rural area or not. But we are also able to do that. We can also give you some advice on sellers financing or master leases. So there are multiple other options other than these 2. All of these loan products mentioned over here that we can cover, and we can help you on those. Sellers financing is very, very popular. Assumable loans. You can also assume loans from the current sellers. Those are another thing. In that case, you will need a second lien holder loans, and we can also help you with those. So there are multiple other products other than what is mentioned over here, and we work with all of those day in and out, and we always help our clients whatever they need. Does anyone have any questions?
Something else that I just thought of, also potentially using private equity, preferred equity or mezzanine products. Currently, what we've been seeing is a lot of investors are looking to those private equity lenders because they're not necessarily on the prime, or they're not necessarily on SOFR, right? And so they're able to offer very competitive interest rates on some of these bridge products. And so the bridge products, with it being the higher pricing, higher interest rates, those private equity lenders were able to, offer a lot more competitive interest rates. But the issue with the private equity is they only want to be in the project for a certain amount of years, right? So really, we saw 2-3 years max prior to this new age, and now we're starting to see the beginning of this year they're starting to roll out with other products where they're potentially looking at staying in for the project for 5 years. They're offering that, and they're potentially offering a fixed interest rate starting at 6 or 7%, depending on a number of different variables. But it's just like I said, it's the financial world is very dynamic, it's very fluid. And so when you have a scenario, or the case that we're in right now with interest rates being as crazy as they are, we are still seeing lenders doing what they can to make sure that investors are able to stay competitive and stay fighting in the industry. So
yeah. And we got a question that rolled in. We've got two here. I know one, y'all are going to cover the process and everything on the next slide. But here they are. So talking different types of loans and how you can really help that. And you've covered all the different asset types. One says a lot of folks are looking for self-storage assets. What type of financing do you recommend for self-storage development, acquisitions, and acquisitions with value add?
Sure. Yeah. So with self-storage, I love self-storage. I love the financing for it. That's really been my niche on the team. So usually what we look for, we'll just start with the bridge product for typical value add. There's a lot of lenders out there that dip their hands into multifamily, and they also dip their hands in self-storage. So they're in multiple assets. And so really private equity is a good source of that. But with private equity, their minimum requirements are pretty high in terms of dollars. And so if the projects, the minimum they want to finance is potentially $5 million, $3 million, something in that range. And so something else we've looked into for bridge, we've looked into SBA 7 Alpha is a good one to use. They do offer a value add component, even though it is long-term permanent debt. It is on loan to cost. They will provide some financing for the construction renovation. We also looked into small banks, local banks, love self-storage, large institutional size. And so those are really the four main, I would say, that we use for the value add component. In terms of ground up development, you get a lot of competitive loan products from private equity lenders on the development side. But the issue with them is they want to see the minimum requirements for their dollar amounts extremely high, $10 million potentially. And so there's not a lot of self-storage development projects that are north of $10 million unless you're in a downtown major market or something like that. And so local banks are a good source for that. Large institutional size banks are a good source for the ground up developments. They're also going to give you your best pricing points too, best terms. And then in terms of long-term permanent financing, you can't use any of the agency lenders. So really what we use for long-term is CMBS is a great one. And also just local banks, large institutional size banks. That's basically it for the self-storage space. Really what it comes down to is going to be the large, the banks and the larger institutional size banks are going to be the most interested for your self-storage project, especially if it's in the area that they're operating in. They know the area better than anybody. And so they're going to be more willing to offer you better terms, better rates, stuff like that on those projects.
And when there is a value add component to it, you get 100% CapEx, capital expenditure. So that's one of that thing, that acquisition 75% loan to value plus 100% CapEx is also an option that you may get in terms of those loans. So that's one thing to keep in mind, that value add is something really banks and all the institutions like. Moving on. Someone had this question, process of the loan. So when it comes to process of the loan, first, everyone would have that doubt, like, how do I get started? Okay, whenever you get a deal from your real estate brokers, the package that you need to put together to send it to us. And think like you are directly sending it to the lender, not to the broker, because we're going to be evaluating, pre-screening your project as an underwriter or as a lender ourselves. So when sending the documentation, what we want to see is the offering memorandum of the project, which will show us some kind of demographic of the project, which will show us some pictures of the project, what year it was built in, what time and how many units the current seller bought it for, what kind of expansion and changes that he has made. So before and after pictures, all that. So that is offering memorandum will take care of that part. Also, it will include some kind of financials into it. But the main thing that we want to see is T12, last 12 months of historical data. How much in the basically P&L, how much income and expenses that you have had from this particular project, what is the occupancy level, all of that will tell us from the T12. And if you need help, we also offer underwriting. So if you are just stepping into commercial world, you don't know how to screen any deal, whether it's beneficial, what is the cap rate, what is the IRR of it, what is the rate of return of this one, then we are able to underwrite those deals for you as well. But that's whole another topic, we can talk about it later. But if you have your underwriting, we are happy to take a look at your underwriting as well. Then we will need to know whether you have experience in managing such kind of asset or not. So you can give us some summary about you. What does your personal finances look like? What is your net worth, liquidity? All of that, that will tell us how much capable you are, so that we can sell yourself and your project to the lender more efficiently. So that's first step, is getting us the documentation, which again, to summarize, OM, T12, any summary of yourself or your experiences, rent comp of the project, if you have anything that you can gather about the project, that would be helpful to us. Next goes to the pre-screening stage on our end. We will pre-screen it. We will review all the data. Everything must match. All the dots must connect. And it must create a nice story for us to give it to the lender. Then we will start contacting all the lenders. But before that, as I said, we will evaluate which lender to take this deal to. Whether it's a private equity lender, whether it's for the banks, it's for the large banks, it's for the hard money, or what. We will first evaluate that. Once we know that, okay, this particular project is for this kind of lender, then we will start approaching all the lenders. We almost go to 2022 lenders and we talk to everybody. We give them the same story, same documentation, and we talk about this project with them as if it's ours, it's our own. Once we have interest coming in from those lenders, they say, okay, we have interest in this particular deal. They will start sending the soft codes. We always encourage to have soft codes in place, some preliminary terms. I'm not saying you are giving me commitment to lend on this particular project, but tell me on what indices you're going to price this loan on. What would be your amortization would look like? Would there be any prepayment penalty? Would there be a recourse option on this one? Non-recourse, what is it? So they will give us some few line items, giving us some highlight how their terms would look like. And we will present those soft codes to you, at least 4 to 5 soft codes for you to choose from. Once you evaluate, once you put those numbers into your underwriting, and you think that code number 1 and 3 are fitting the best in your underwriting model, then we will start the process with those 2 lenders and we'll take it forward. Once we have those 2 lenders decided, we will tell them we are ready, what we need to do next. And their answer would be, okay, share every detail about the borrower. Now they have underwrote the deal already. They want to underwrite the borrower. They want to know how strong, what is the strength of the borrower is. In that, they will also check your credit score. They will check your global income, source of other income, whether you have other income to support in case this particular project goes into default. How many entities are there? How many sponsors are there? Whether this is a syndicated deal. All of those things, they want to look into it. Once they have that, they underwrite the deal in-house. They take it to the committee if it is a bank deal, and committee's approval comes from there. That's when we get the commitment letter and they start the third-party reports. Third-party reports would include appraisal, environmental report, phase 1, ALTA, title. They'll do the survey, inspection, all of those things. And they will evaluate the property. Once everything looks good, we will have a final approval and disbursement of funds. That is called closing. Usually, banks don't like to lock the rate until we are like a week, 2 weeks away from the closing. That's when they will lock the rate first, and then we will have our disbursement of funds. And all the happy faces all around. Hayden, do you want to add anything else to it?
Yeah, that makes you bring up a good point with the rates locking. Something else to consider with agency debt is Fannie Mae's interest rate will float until closing as well, whereas Freddie Mac should lock application. So usually Fannie Mae has more competitive interest rates than Freddie Mac. But recently, like I mentioned earlier, Freddie Mac really made a push earlier this year to really step up their competitiveness with the interest rates. Sadly, that's starting to go away, but it brings up another good point with the interest rates floating as well.
So I have a question in terms of the lending process. Obviously, you've gone over and covered everything that you guys need. At what point, as the sponsor, should you begin shopping that debt? Once you have your deal, you've got your LOI out, your offer's accepted, at what point do we begin that shopping process to really ensure that we can get the best rates at the beginning to get our performant underwriting locked in to know what we're getting in terms of financing?
Sure, I would advise as soon as you get the projects, you've gone through some underwriting of it, you've screened it a little bit. You know that there is some potential here. That's when I would recommend you get on the phone with one of us or a broker to really understand, just a high level, what kind of terms are we looking at for a project like this? Me and Radha, we're constantly dealing with other loans and talking to other lenders, always trying to sharpen our pencil as to what terms are looking like, not right now, but also in the future, a month from now. And so I would always recommend, as soon as you get a project in your hands and you've gone through some basic screening of it, underwriting of it, that's when you should start reaching out to see what your financing look like. And like I mentioned earlier, the financing is probably going to be one of the biggest aspects to making sure that your project is successful. Because when you look at the full capital stack breakdown, who's paying for most of the projects? It's the financer. So yeah, I would always recommend for my own projects, I do the same thing. I do a quick little screening, I do a quick little underwriting. Okay, there is some potential here with this project. Let me get on the phone with some of our go-to lenders and see what kind of high level soft terms are we looking at for this project.
Yeah.
Great, thank you.
I'll kind of speak on that from, the operator's point of view. I talked to a lot of, brokers, for multifamily, talked to a lot of deal sourcers for the self-storage now. And those ones that come back around, more times than not, the reason that it came back around and fell out of contract is due to the financing. They always say the funding, and a lot of it is because these the underwriter, the sponsorship team wrote it at that time's interest rate, not factoring where they would be closing at. And when we're talking about, look at what happened last year, interest rates were going up by the 50s, by 50 basis points at a time. They've slowed down and only increasing by 25 basis points at a time. But if you understand how the cash flow works, and one of your biggest paychecks out of that project is your loan service, that 25 basis points could make or break a lot of deals. So especially with the compressed cap rates that we're still seeing in the market. So that's why I always, as part of my process, when I've got my deals passing, I'm kicking it over to Peyton or Rada to start shopping the debt to make sure that I'm not being unrealistic with my terms that I can close with. So it's very important to talk with the brokers that are keeping their fingers on the pulse of the market and how it's shifting. You know, are we still on a shift up? Are we on a shift down? You know, and really making sure your business plan before you start going and raising capital and spending your money. That, you know, I talked to one lady that she lost about 250,000 in EMD money, and it was all because her loan could not get approved. And that took me all of about 5 minutes to look at that and go, yeah, you're not getting that loan term at this today's market. So if you want to save yourself from losing EMD, I would highly recommend this. You know, I do it before I even put together an LOI. That's how really I put mine out there.
Yeah, you definitely want to have those conversations before you put an offer in. And it's as easy as picking up the phone and just calling and asking, you know, these are the term, or this is the idea, or the project itself. You know, what can I expect so I can make a better offer on my own deal? You know, what kind of financing can I expect on this project? So.
You want to cover this?
Yeah, sure. So these are some of the common loan covenants that you'll see. And going back to the types of lenders and something that we discussed earlier, you know, each specific type of lender is going to be more strict on one of these loan covenants than, you know, a different type of lender, right? So the agency, your permanent lenders, are very strict on DSCR and debt yield, stuff like that. Whereas your bridge lender, not necessarily so concerned with DSCR or debt yield, but financial markets change all the time and they're very fluid. And so these are probably some of the most important covenants that you want to know and understand. Your debt yield is basically just taking your NOI, dividing by the loan amount, and then you're going to times it by 100. It just gives you a percentage. And so really the biggest ones with the debt yield is probably your CMBS lenders are very big on debt yield. I think the lowest I've seen, a minimum requirement 8-9% is probably the lowest they'll want to see. Whereas your bridge lenders, and that's going in usually day one, right? And so usually with the bridge lenders, they're not necessarily, they understand there's a lot of turnover. There's a lot of, you know, you're basically flipping a property with the bridge product. And so the debt yields, they're not necessarily so concerned with it year one, year two, because they know you're not just seeing that cash flow quite yet. DSCR DSCR is always going to be very important in any market that you're in. You know, DSCR basically is just taking the loan amount, dividing it by the construction cost. Well, what you're looking for with the DSCR is more of the cash flow of the project. And so lenders, a good rule of thumb, lenders want to see 1.25 or higher. And so that's taking your income, minusing all of your operating expenses, and then taking your NOI and looking at, you know, how much cash flow do I have coming into this project? You know, can it pay off the loan, the principal and interest payments? And so very, very important that we understand the DSCR. Loan to value is basically just the value, the appraised value of the project that you're looking at. A lot of permanent lenders only lend on loan to value. They don't want to lend on any type of construction cost, and so, or renovation costs, stuff like that. And so that's really more of your permanent side is going to be lending based off your loan to value. Loan to cost is more of your bridge products. Short-term financing, they're going to help you pay for the purchase price, and on top of it, they're going to help you pay for the renovation costs. Net worth and liquidity, that really comes down to the guarantors who's signing on the loan itself. You know, they want to see that the guarantors and the rest of the sponsorship team, they have a significant net worth. You know, so they're really looking for, you know, with the net worth piece, they're really just looking for, you're not someone who doesn't have a lot of experience in the industry and you're trying to acquire a $50 million apartment, right? They're going to see that and say, your net worth really isn't there. And so ways to kind of get around that is just basically bringing on a loan guarantor who does have that net worth, who does have that liquidity, post-closing liquidity, who can assist, with you closing the transaction. And so the lender is really going to look at those two things and see, if this thing defaults, heaven forbid, if this project defaults, do you have post-closing liquidity to help keep the project alive before it defaults? Do you have the net worth and the experience to see this thing all the way to the end? And so those are important things to look at. Every lender is going to be different with the net worth and liquidity requirement. It's important to know that. And so, Radha, do you have anything else you wanted to go over?
Yes, for the liquidity, I want to highlight one point. It's for the Freddie Mac loans. They want to see 9 months of liquidity after the closing. So you have debt service to cover for next 9 months sitting in your bank account to cover the debt service for that. That's Freddie Mac rule. But otherwise, they want to see 6 months of reserves in your account. Usually that's the minimum that they want to see. That's the reason for liquidity. And 2 points which are not covered here in covenants is, and it's usually missed out upon by the borrowers, is one, experience. They think that, oh, I have experience in retail, so I should be able to do this particular business. Or I have experience in property management, so I should be okay buying a multifamily now. No, they want to see the management side of the experience. So they do emphasize a lot on the experience side. And second thing is global income. They do want to see your other source of income as well, which is usually being neglected by the borrowers. So just to give you one example, one borrower came to me last month, told me that I have a land which is paid off. I have a house which is paid off. All of this is certain $1 million. I should be a good candidate to get the loan. The one thing that he did not get loan on, the first and primary thing was that he did not have any income. He wasn't doing anything. All the assets were paid off. Everything. He had good net worth. He had liquidity. He had DSCR on the project. Everything was fine. He had credit, but he didn't have any other income. So that's what stopped him from getting a loan. So these kind of things usually, they do look small on the first hand, but those are the major points that lenders do give attention to.
Sweet. Well, I think can we go over the next slide? There it is. So different ways of how we can help, and kind of some things that may set us aside from other brokerages. We will always be able to review your project and advise on your performance. That comes from the experience on the operating side and actually closing deals ourselves. We understand the stresses of once the closing is only part of the project itself, right? And so a lot of brokerages, they close and then they're out of the picture. So we understand the process of post-closing timelines. We work with a lot of project managers and asset managers. And so we understand kind of the process of how it's going to move forward. And so that's something that we could always provide to you guys is advice on your pro forma, and also go into the second point, full service underwriting. I mean, I love underwriting. I can underwrite very quickly and very effectively. And so I'm always able to underwrite projects, self-storage, multifamily, a little bit of hospitality. And so that's something that we could always provide. Usually we actually do create an underwriting for every project that comes in anyways. But that's more for the lender themselves. And so also something, with shopping debt, picking the best product for your project, I think that's very important because, depending on your business plan and your pro forma, just because X lender is offering a better interest rate doesn't mean that it's the best product for your business plan. And so that's something we're very understanding and very aware of. And, we're always able to kind of advise the clients, advise you guys on what products we really should be trying to achieve with your project itself. And so, Radha, do you want to go over the last three?
Sure. So one thing I would highly recommend is that consider Centroid and Lending just for one very strong reason is that we do have experience of acquisition. We know what it looks like on the other side of the deal. So we have hands-on experience, and that's why we do understand the importance of having a good underwriting in place. We understand that there could be sometimes problem of having a guarantor in the deal. Sometimes banks don't like the property managers that you are using. They ask you to change, and all you know is one property manager on board. So we have recommendations. We have multiple people on board with us that we can recommend. So that's what stands us apart from other mortgage brokers. What we do, probably everybody out there does it, but what stands us apart or with how we are different is we are able to help you with in many other areas. I have a loan going on right now that property manager, this particular bank would not accept. They want them to change, and they did not have any clue who to go with. We help them. I have a borrower whose net worth is falling short. Banks are not happy with his financials because he didn't even file his tax returns. One of the co-sponsors for 2021. Now they are having a problem of having a good guarantor or no net worth in there. We have guarantors. We have connections that we can recommend, and that can probably help you pass that last hurdle to close the loan, to get that final approval. And we are syndicators as well. Sometimes you need investors, we can help you in that too. So any which way, anyhow, we can help you close the deal. We're gonna be standing on your side as a backbone, and will definitely help you. Peyton came across a very good deal recently, Archer Village, in some cities. So Peyton, do you want to highlight that?
Yeah, sure. If you don't mind, I'll share my screen and kind of go over it. Briefly.
Yeah, I know we're coming up on the end of the hour, so I appreciate everyone. These are going to be 2 case studies. This is actually this is Matthew's deal that he had submitted a few months back, but we had looked at the debt for that one with Peyton and Radhika shopping that for us. So
Sweet. So yeah, with this project, this is a typical value add project. A lot of renovations was gonna go into the project itself. And so originally we were looking at just knowing this, we're looking at more of a bridge product going into the property. But as we kind of started going into the weeds of the financials and the unit mix and rent roll, all the documentation that's required for us to start shopping debt, we actually noticed that there's enough occupancy. They want not usually 90% occupancy on average for 3 months. Well, that actually hit that requirement. And so now we started shifting gears. Okay, we don't need to go to a traditional bridge lender. We can actually start going to agency lenders. And so once we got on the phone with one of our late agency lenders, it really turned this deal into a good deal. Previously with the bridge loan, we weren't able to, the buyers weren't able to offer as high of a purchase price, and the IRR was a lot lower than 21%. And so I thought this is a good case study to look at, because it shows, we can, once we start looking into the weeds of the financials and the unit mix, potentially we can go over and find something that a different product that's just going to strengthen your business plan and your pro forma. And so yeah, I like this deal. This is a pretty good deal.
yeah, as far as the loan, because I was helping Matthew with this one, as far as the loan, I think we were coming to y'all going, hey, I want a bridge. Hey, I want a bridge. But then once we typed in the numbers and you said, hey, I think you should consider an agency, our numbers shot way up. Yeah. And we ended up going, that route, which is great, especially in, talking to your investors and talking to everybody in this market right now, factoring a refinance. I don't know about from some of the other operators out there, but they get a little skeptical. They get a little weary whenever if you're still factoring that typical, 2-year bridge, 3-year hold afterwards for a 5-year total time, that they're still not comfortable with that. So going straight into a permanent debt was going to be great. What ended up killing this deal was the fact that we found out how much of it was located in a FEMA flood zone. That was the only reason we didn't pull the trigger on this one, but the loan terms and all of that were fabulous on this one and helped us out a lot.
Mm-hmm.
So, well, I appreciate y'all running through everything. It's a lot of good information. I know for some, it's not the most intriguing and interesting. However, if you are serious about wanting to build a portfolio in commercial real estate, you've got to find this at least somewhat interesting, because this is ultimately talking about how well your deal is going to perform. I would say, I mean, when you're talking about, like y'all said earlier, more money is coming from your lender than your investors. So if you don't take that into, if you're looking at 75% or more of your deal is from your lender, that dictates a lot of your holding period. How much cash flow is there? How well you're going to be able to finish CapEx or construction. So it's not just about having the best terms. It's about having the right lender that's the best fit for that project. I've learned that firsthand in my previous experiences, that if the lender doesn't understand the project and the business plan, they will work against you every step of the way, and that could ultimately kill a deal. So from then on out, I've always been looking for the best brokerages that can help find that right fit for your project. So I appreciate y'all both coming on and talking with that. How can everybody get a hold of you if they would like to, approach you about some of their projects? Do y'all want to share your contact infos there? Okay, sweet. So there's how to get a hold of them.
And I'll also, in the event posted in the group, I'll comment on it and drop my email and phone number.
Yeah, that would be great. Well, I appreciate everyone. I know we went a little bit over this time, but I thought it was well worth it. There's a lot more that they could probably go in depth on. So if you've got a case, that you're looking at, a project you're diving into, they will be able to go into the weeds with you specifically. But since we're here, are there any questions before we disperse for the month and everyone goes, enjoys the rest of their Friday and gets back to getting those deals done? So any questions while we're still here? No? All right, good. Well, if you think of any when you're out, or if you're watching the recording in the group and you think of some, feel free to post it in there. And Peyton and Radha are both in the group, so they will be able to, see that there's questions on that and rock and roll. So thanks everyone for your time. Feel free to keep an eye out for that. If you've got anything going on and you want to share it and ask, I mean, this group is here to help. So I hope everyone in the group is willing to, add to, pay it forward, invite their friends, as well as, if you've got any questions or you need anything, come to the group, come to us. We're here to help you. We want to see this group grow, and let's go for, I think we can do 100 million plus this year just within this group. That's the goal. So all right, everyone. Thank you for your time. And oh, yeah.
One more thing. Sorry. Oh,
okay.
Go ahead, Peyton.
No, I was just saying thanks for having me on.
Oh, yeah.
Oh, thank you guys for coming on and sharing your knowledge. I know that for everybody in here, debt is going to be an important key part to getting some deals done. I did want to make an announcement for next month. We have Brandon Wong coming on. He's going to be talking through some smart syndicator capital raise strategies. So we're excited for that. That will be April 7th. And once I get everything set up, I will send the invite out to everyone for that. So we look forward to seeing you again in April. I know Brandon's got some pretty massive stuff going on that he's going to be excited to share. So that's it from my end. Thank you, everybody, for joining. I think we can go ahead and end the recording.
Yeah. Thanks, everyone. Y'all have a good one.